Now, just minutes ago, we heard from the chief economist at Goldman Sachs. That bank is forecasting an 18% gain in U.S. stocks this year. But what about emerging markets? They soared last year. Can they continue that rally? Joining us now with his outlook is Ajay Kapur. He's head of Asian equity strategy for Deutsche Bank. Always a pleasure to see you when you're in town, Ajay. Thanks so much for joining us. What do you think? Emerging markets, a lot of people use words like frothy. We have Jim Chanos on who says big bubble, be scared, and yet most everyone else is bullish.
My view on emerging markets is I'm reasonably bullish, but I think they'll underperform the developed markets like Japan, Europe, and the U.S. And there's no bubble in emerging markets. There might be a few sectors here and there which are looking bubbly. I think Mr. Chanos is talking more about the Chinese real estate sector. So there's some...
That doesn't concern you? I mean, we see videos of these ghost towns.
And look what the U.S. real estate bubble did to the U.S. and global economy. So that does worry me.
I think there are imbalances in China. I think those are pretty well recognized. The Prime Minister himself used the word imbalances. And so in China, they want to...
But is it an imbalance? Or, like, to me, imbalance feels like, you know, we're cushioning it.
Right.
I mean, versus a bubble. We've talked about these ghost cities in China, these major developments, and there's nobody living in them.
Yeah, I think there's little doubt that the Chinese real estate sector in the Tier 1 cities is quite bubbly, both in terms of price and the quantity of flats that are just lying around. Because, believe it or not, the home ownership rate in Tier 1 cities in China is about 80%. So, you know, any more building is going to be a second or third home. So, yes, I think Tier 1 is a problem. Tier 2, Tier 3, and there are many, many cities with millions of people in Tier 2, Tier 3 still need more housing.
So it's manageable. You're saying it's not going to be if this bubble bursts.
You know, bubbles are never manageable, even though one likes to think they might be, and policymakers might think that, but they really aren't. Having said that, Chinese property stocks are a pretty good leading indicator of bubbles and busts. And they're now down about 50% in the past year. And for the last 3 months, they've stabilized. So I think the equity market in China recognizes where there's froth. I think in ASEAN, to Matt's point earlier, till about 2 or 3 months ago, markets had not recognized the froth in, for example, consumer stocks. And those stocks have been hit very hard now because they were trading at 5 times book value. People love the noodle story, the diaper manufacturers, you know, the cigarette guys, and those have come off quite sharply. So I think we'll end the year higher, probably 15 to 20% higher. I think earnings are going to be pretty good in emerging markets. I think the earnings expectations are pretty low. And the world central banks are pretty easy. And the tape, the technicals are very strong. And we have an M&A cycle in the world. So you don't want to get too bearish on equities wherever in the world, given all those conditions.
What do you think about governments dealing with, I mean, capital inflows obviously are being given a turbo boost by Ben Bernanke and the other developed world central banks. You see, you'd have to say massive inflation, at least as far as commodity prices, right? I mean, do you think that emerging markets are handling this correctly? Is it going to cause more problems in the future?
I think there is an incipient inflation problem in some emerging markets where we think the central banks are probably slightly behind the curve. Indonesia is one. India is another one. China, we actually think that monetary policy has been tightened reasonably. There's more to go in terms of interest rate moves up. We think about another 50 beeps by this summer. And then that's about it. So it really depends on which country you're talking about. I think most of them understand that there is a moderate inflation problem and they need to do something about it.
What do you like? I mean, if you're a U.S. investor who wants to allocate some of his portfolio to emerging markets, where do you recommend he take that exposure?
Okay, well, I think Korea looks pretty good. So the general theme is that countries in emerging markets that are U.S. facing should do quite well because the U.S. economy is recovering. Deutsche Bank's forecast is for 4.3% GDP growth for this year. So a country like Korea, where stocks are cheap, with a pretty high U.S. exposure, parts of Taiwan, Hong Kong. Hong Kong has the same monetary policy as the U.S., so we've got 0% interest rates there. Even though China is booming, rates can't go up because of our currency peg. And other countries like Mexico, which again are pretty linked to the U.S. So last year's stories were all about domestic demand and pricing power in the large countries like China, India, and Indonesia. And this year the stories changed to more externally oriented countries and exporters.
Ajay, just quickly about, because you're right, fears about China's inflation have come a year too late. When we get those headlines of the Chinese central bank, raising rates to slow down inflation concerns, isn't that them just being responsible? Isn't this what we want to see them do? Are markets wrong to kind of overreact and kind of freak out?
I think the Chinese markets are pretty calm. I mean, think about it. You got this data out last night, and the CPI number was only 4.9 compared to 5.4 or so expected. So my view is the time to worry about the CPI stuff was a year ago, because since then they've tightened policy, and I think they're doing the right thing, the responsible thing, and the equity market bottoms out before inflation peaks out. So we think inflation is going to peak out probably by June. So we think the Chinese equity market should probably bottom out early second quarter.
Buying opportunity?
I think so. Yes, I think so. And I think apart from there's one other emerging market we didn't talk about, which is Japan, which looks very cheap to us. Both our strategist in Tokyo, and I also think it's very cheap and looking pretty good.
That's interesting. That puts you in a space with very few big-name investors.
But more and more people are starting to look at Japan again.
Precisely, yeah. So a lot of our hedge fund investors are getting positioned into Japan and shorting parts of Southeast Asia, but the long-only investors are still very shy. And
they remember history.
They remember history, and there's a feeling of revulsion towards. They don't want to hear the story at all.
So what's your investment window look like there? Because we talked to a lot of value investors. Jean-Marie Eviard obviously has loved Japan forever, First Eagle Global Funds, but his window is like eternity, right? I mean, how far are you looking out?
I'm looking out 6 months. Eternity is too long. Yeah.
All right, but we do have to go now. Hey, Ajay, thank you, and thanks for finding time for us while you're in town. Ajay Kapur joining us here on Street Smart.